IVM.
Helping us pay our bills this week is PayTM Money.
On this episode of Paisa, Vaisa, I speak with Jay Toshniwal, CEO of Toshniwal Equities, and we are going to talk about wealth generation in equities, how to choose stocks, sectors, and how to stay invested in the stock markets to create wealth over the long term. If you want to know more about this, stay tuned for this episode. Is your KYC taking days and weeks? Well, now you can actually complete your KYC verification on PayTM Money and also have it approved on the very same day. Guess what? Mine was approved within 30 minutes. So why delay when you can invest today? अब म्यूचुअल फंड्स के लिए भी पेटीएम करो. You can download the PayTM Money app on App Store or Play Store. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter. Now we know that equities held over the long term, have the power and potential to generate a lot of wealth. Question is how? And my guest today is going to talk exactly about that. Wealth generation with equities. Well, on to my guest, Jay Toshniwal, CEO of Toshniwal Equities. Jay is a veteran of the stock market, and Toshniwal Equities is also among India's bigger brokerages. Let's get on to know more about him. He has come from Worli to Khar, and now he's going to go from Khar to South Bombay. It's so nice of him to join us. Jay, welcome to Paisa Vaisa. Tell us something about yourself so our listeners can know you better.
Good morning. It's a pleasure to be with all of you today. I have I had passion in finance all along. I qualified as a chartered accountant, did my MBA from IIM Ahmedabad.
Hold on. CA and IMA.
Yeah, and IMA after CA.
My God, I don't get to be people doing that. मेरे को तो CA करते tough हो गया. You've done CA and IMA. That's a fantastic qualification.
See, CA gives you a depth of knowledge,
right.
Expert level of knowledge, and MBA gives you a lot of breadth of knowledge. You understand various facets of business.
Okay.
So combination of this is, I believe,
super.
one of the good combinations.
Sure.
And I had a passion of finance, passion in stocks. I used to trade when I was in school, in college also. So, but I thought that it's better to work in industry for a few years to understand real business at ground level before coming into stocks. So I worked for about 7 years in industry, setting up a large plant near Mumbai, manufacturing plant in Birla Group. And then I worked earlier to that in consultancy and also with a company into marketing. Okay. So I had a 7-year experience and that gave me real depth of understanding of what industry is, because being in the financial world, we think that, the chicken should come out tomorrow, but that doesn't happen. So that understanding of industry, the way it works, gave me tremendous knowledge and depth to whenever I read any balance sheet of a company or attend any analyst meet. So when the management talks about something, I can really appreciate as to what's behind it.
Right. What about Toshniwal Equity? When was it formed? What's the background? What does it do?
Yeah. After having worked about 7 years, I left Grasim and started my own business. Initially as a sort of a sub-broker, but realized that we have to have proper foundation in this business. So we became members of NSE, BSE, took up MCX on currencies, commodities and currencies also. And since about 25 years we are into this business now. Developed our business, have a few branches. And we focus on retail business, and we have a small prop book also. We used to do arbitrage business also earlier, but nowadays that's not profitable. So there's not much of that. And largely Bombay-centric company with some setup in Rajasthan. And earlier I had some setups in Karnataka also.
Okay, so 25-year-old brokerage which has equities, has commodities, currencies, NSE, BSE. You're probably the best person to tell our listeners about the long-term story for investing in Indian equities, right? Because we know that a lot of people are now becoming more familiar with the stock markets. There are SIPs which are now fairly large in number of SIPs and in the quantity also. So what exactly is the long-term story for staying invested and holding Indian equities with the power and potential to generate wealth on the long term?
When you talk about equities, we have seen in the last 25 years how people have created substantial wealth by remaining invested in equities. We've also seen people destroy wealth by remaining invested in equities, probably in the wrong stocks.
Yeah.
So that classification and where you invest is very important. But the story of equities actually is linked to the story of the economy. So we are, all the corporates which we talk about within an equity market, they're all parts of the ecosystem within the economy. And if our country is going to grow, Each company will grow their business, and automatically it will lead to profits and growth in wealth invested in the companies. So when we talk of equity on a long-term basis, we are talking of India growth on a long-term basis. We have seen our economy grow over the last few decades, and from say 2008 was a turning point, sort of when we crossed about $1 trillion economy.
Yes.
And since then we are now about $2.6 trillion, and we are talking of reaching $5 trillion maybe 2025-26.
Right.
And the finance minister recently said during the budget speech that we'll cross 10 trillion by 2030.
Right.
I believe it will be 2033, but whatever it is.
Sure.
So when you see such a large pie of value and increasing size of the pie, so definitely there's more for everyone to share. Now it's a question of how you can pick up your pie.
Right.
That is the expertise we should have.
Yeah. Do you have any rough numbers in terms of how the stock market over longer periods of time, the kind of rate of return it's generated and how that's related to GDP? I believe the numbers that we have is 7% GDP, maybe 3-4% inflation. So 11-12% is what we can look at. Is that the right way of seeing things?
So I would modify it slightly. We say 7% growth, about 4% inflation. So 11-12% is a nominal growth, so to say.
Right.
Earlier it used to be around 13-14% because inflation used to be higher. But going forward with this 11-12% nominal growth, a good company would normally like to increase its market share, increase the presence, widen its offerings. So that company would normally grow at 1.5x to 2x of the growth of the economy.
Sure.
So good companies, growth companies would typically show a growth of around 15 to 30%, 20-30%, that range. So those are companies who will outperform and offer great value. And if a company is unable to grow beyond 11-12%, then probably there is a chance of losing value in such companies.
Okay. Now let's get down to the two. I'm sure what everyone's wondering is how do you identify such companies? Okay. So one big theme I know that has been happening in the last maybe 10-20 years as compared to what used to be before. Probably you would know that since your firm is 25 years old. Is corporate governance, right? And how things were before, how things are changing now. Aside from all that we hear in the newspapers about specific companies and specific banks or whatever it is, there is still a general change, right? Annual reports are better. Promoters are generally waking up to the fact that if you have better corporate governance, then maybe, that could lead to better shareholder returns. What's your view there?
When you talk of corporate governance, we're going back to the basic concept of company when we learn in our economics or finance in college days. A company is a entity where there is a promoter, a main shareholder, and there are public shareholders.
Yes.
Okay. Our corporates have evolved in a sort of a Lala way, Lala company sort of.
Yeah.
The promoter always thought that even by holding 30-40% of the shares, he owns the company and he runs the way he likes it without bothering about other shareholders. So that's the way the companies have grown. Some corporates, some managements have understood that we have to grow large, we have to raise capital, and we need to be honest and fair with the other shareholders. So they have evolved. And with improving corporate governance, having due respect for the other shareholders, they have been able to really create value. But some promoters, even today, we find that they have scant respect for the fellow shareholders and they take decisions which are in their own individual interest and not in the interest of the other shareholders. So such companies have destroyed value and they will continue to do so the same thing. Over the last, say, 20 years or so, 30 years, substantial improvements have been made in corporate governance, driven by regulations and also driven by market. Market is the best barometer. So wherever there is a fall in corporate governance, market beats down the share price. We have seen recently some cases. Last 5 Fridays, we call the Friday Fury nowadays.
What is the coincidence out there? Everything happens on a Friday.
That's a coincidence. Probably the set of people who may be active on this side probably like Friday so that they can enjoy the spoils on the weekend. Yeah. But that's more of a coincidence. Yeah. But what has happened is that in all these cases, if you examine, you will find that in each of these corporates, the promoters, they have their own shares. They are entitled to do whatever they want to with that. What they have done is they have pledged their shares to raise funds and invested in a new business, which could have been promoted by the company and not by them individually.
Correct.
So the idea behind the promoter is that we will invest this money into a new venture and let the venture grow. So our value will become 10x types, then come out with the public offering. So they make money. Had the corporate itself promoted the venture, the shareholders would have benefited. But here the promoter tried to benefit. So for example, Apollo. Now, Apollo, they have raised about 1,400 crores by pledging their shares to invest into Apollo Munich Insurance. Now, the brand name of Apollo is there in Apollo Munich.
Correct.
If Apollo Hospitals had promoted that company, the Apollo Hospital shareholders would have gained. But the promoter thought that we will invest it We'll create value for ourselves and divest later on.
Correct.
So this is the thought behind most of these companies. So all these Friday Fury, what you find, this is a sort of a sample case. So promoters tend to promote ventures, probably use resources of the company to generate new ventures which are owned by themselves privately to create wealth for themselves. This is where corporate governance falls. And that's wherever markets have found it, and markets have beaten them down.
Right.
We have seen various companies, for example, say the best companies to talk of, probably Hindustan Lever or Nestle, most of the multinationals, so to say, and some of the Indian corporates. You'll find that they have grown through their own company. They have not created satellite companies, subsidiary companies or holding companies to create other entities. So such companies have focused on the business, grown the business, and all the benefits have come to shareholders, whether they have made a profit or loss, whatever it is. So there, the promoter shareholder who is managing the company and the other shareholders who are not managing, they are sort of at par, their interests are at par. Such sort of corporate governance is being rewarded by the market.
Okay.
So accountability, transparency is most important.
Okay.
And markets are the best barometers for this. Regulators are driving corporate governance by increasing level of disclosures, trying to have the same timing of disclosures to all sets of people. But I feel that there are various things regulators still need to do. They still need to understand and evolve. And I feel that we have reached a stage where due to regulations, we have too much of disclosure, which does not give any information. So if you look at an annual report of any company, it's like 200, 300 page book.
Yes.
And you don't find the information you want.
Yes. Find a good promoter. I think is a risk in any which way. I mean, you just have to go with what you see. But in general, when you're investing in a company, look at the promoter, look at the background, look at his decisions, how they have shaped out in the past. That should give you mota an idea about how he's going to behave in the future. Would that be a good tip, a good advice?
When you talk of finding a good promoter, I would say, okay, when you marry, you try to find a life partner.
Yeah.
So you, either it's arranged or love, whatever it is, you find a partner whom you are willing to be with and trust them for your life. So similarly, when you invest your money into a company, you have to identify a promoter whom you would like to be with for a long time.
Sure.
So you should have trust in the partner and trust that he will take care of your interest.
Okay.
So that is the basic point in selecting a promoter.
Okay. And in general, you think that the level of corporate governance in India is improving as compared to what it used to be at one point of time?
It has improved substantially, but I would say more towards disclosure driven by regulation.
Okay.
But I think we need more improvements in terms of getting the right set of information.
Okay.
Now, for example, various companies have analyst presentation. There's a presentation given after the results are declared. Now, why doesn't the result or the quarterly report, annual reports cover this thing? Why it should come separately? So that report is trying to explain to people as to what we have done.
Right.
When the annual report is supposed to do that.
Right.
So that way there is a disconnect between what regulators are driving and what is being done.
Sure.
Similarly, to give another example, there are a lot of investor conferences organized by various brokerage houses or fund houses.
Correct.
Now, what is the reason to organize this? When all the information is there in public domain, there is no reason for anyone to go to such conference. So which automatically means that these conferences are organized to enable additional information which is not known to market to flow between issuers to the investors.
Correct.
Which is presently, I feel it's not right, but that's what's happening.
So
again, regulators have to wake up to such things. So I feel that the level of corporate governance still needs to evolve.
Okay.
So there's more transparency, speed of dissemination of information. These things still have to be done.
Sure. And on that note, we take a small break. Don't go anywhere. We'll be right back.
Hello, everybody. Welcome to another awesome week on the IVM Podcast Network. If you aren't following us on social media, please make sure that you are. We are IVM Podcast on Twitter, Facebook, and Instagram. If you are following us on social media, I'm sure you know that it's our 4th anniversary this month. Yeah, IVM is 4 years old. We've done 3,500 plus episodes of content, and it's been an amazing ride with a lot of fun guests, a lot of fun content, and a lot of great hosts. We'd like to thank all of our hosts because without them, we wouldn't really be doing all that much. Also, I'd mentioned over the last couple of weeks that we're running a survey right now, a listener survey. It's on ivmpodcast.com/survey. If you have not filled that out, please do fill it up. It'll help us figure out what is working for you, what's not working, and will give us some information that we can use to get some advertising on the show. On The Scene and the Unseen, Amit Verma is joined by author Srinath Raghavan. They discuss the recent tensions between India and Pakistan, its historical context, and what the future may hold. We're launching a new show called States of Anarchy about global affairs, hosted by foreign policy enthusiast Hamsini Hariharan. On How to Citizen, we move on to Chapter 8, Confronting Marginalization. Meghnad and Shreyas are joined by creative director Joel Pereira, who draws from his professional and personal experiences to discuss the topic. On Advertising is Dead, Varun talks to executive editor of Rolling Stone, Nirmika Singh, about new age journalism, what it takes to be a music journalist in India, the rise of Indian hip-hop, and a lot more. Also check out last week's episode with Gaurav Kapoor, founder of Oak Tree Sports and former VJ, who talks about his journey to becoming a sports presenter and what's missing in our sports content. On Golgappa, Tripti is in conversation with musician Karan Chitra Deshmukh. He talks about how he got into playing instruments and gives a glimpse of his talent on the show. On Geek Fruit, Tejas and Jishnu talk about their favorite classic TV shows and give their opinions on which can be potentially revived. Also check out last week's bulletin where they talk about IVM's 4th anniversary and their favorite shows on our network. And with that, let's continue with your show.
And welcome back to the show. Markets have also changed, right? I mean, corporate governance is one thing that's improving and keeps on, probably improve for the better as we go on. But markets, the composition of the leaders, so to say, has also changed, right? You first, in 2000, you had the IT boom. Then I believe in 2008, you might have the real estate and infra boom. Today, it's something else. What's your view on that?
Basically, this reflects the changing economy. From an agrarian economy, we became an industrial economy, and now a service-driven economy. And within services, again, we are now more into a IT and finance-driven economy. So, as the content of the economy, the value addition, people who create value in the economy, as they change, the leaders would automatically change. So, you had the textile companies in 60s, 70s, then you had the FMCG, white good companies in 90s, you had the IT coming up in 2000. 2008 was, as you said, a time of infra and realty.
Yes.
And now we are going into an infotech revolution, a digital revolution. So, we are evolving into something where products and services will be delivered through a different medium and with information available at fingertips. So, as the content of the economy changes, the composition changes, the leaders will change. A textile company cannot lead the market today. Whereas a software company can lead. Similarly, a FMCG white goods company may be a leader but not the top leader. It can be somewhere in the middle or little lower down. So that way the composition economy creates new leaders, and I'm quite sure every 10-15 years you find new leaders coming up, and as you go forward you will find new leaders emerging, and some of the companies may be just going down.
Do you have a view on, in your opinion, which could be the leaders in the future as compared to where we are now? Just maybe, a few industries, a few sectors maybe?
I feel that information technology, as we see now, and the internet and delivery of content through various mediums. So I feel that product innovation, service innovations, delivery innovations, usage of computers across various business facets, logistics, and still infra also. So these are the areas where I feel that we will find a lot of innovations, changes happening, and these are the growth areas. And companies who are able to do a proper business within this sectors, these sectors would throw up new companies, or probably a few existing companies could grow into these things and develop into great leaders in the next 10-15 years.
Sure, these are probably the growth areas. Anything in the mature industry that you feel will still be a reasonably good area to bet on? Maybe, something like banking or consumer, anything there?
On the mature industries, again, you come back to the basics. Now, daily consumption items will always be consumed. You will always take a bath. You will always brush your teeth. So, FMCG companies, so to say, will always be there. And similarly, you have money, you have to put money somewhere. So, banking industry is going to be there. So, the daily necessities of life, companies which serve your requirements in these areas will definitely be there, provided they manage their business well, they are able to reach out to more customers, widen their distribution and control the cost, create a brand, a loyalty. So such companies will always be there. And another thing which I have been noticing is that the brands earlier were based on products. So a product had a brand. Now you have service as a brand. Probably will move towards an experience being a brand.
That's interesting.
So when you talk of, say, Inox or PVR or such things, they are more of an experience. Or you go to gaming, or you go to a park. So they are more of an experience. So we are moving into a place where experience will also be branded. So when you're going to a park or say a PVR, so you know that what sort of experience you're going to get. Movie is a content, but you will enjoy the ambience. So maybe restaurants. So when you have a chain of restaurants, similarly in hotels, when you have a chain of hotels giving a standardized experience everywhere. So when you book a hotel, say Taj or any hotel, so you know what to expect. So brands on experience also will play a big role.
That's really interesting. So now, last question is how do we implement this? Because now that our listeners know that a few things, like for example, corporate governance is a great theme to play on. The changing nature of the markets is also an interesting thing. You mentioned specific industry, specific stocks also. You can help us with the right way to create wealth, right? Because in the past also these stories came and went, and probably people bought at a very high level, and then and then the market crashed. So let's spend this last part of the show just talking about this specific part.
I think when we talk of value creation, it is created over time. A child can't be born in less than 9 months.
Sure.
Okay. So similarly, whenever a person invests in stocks, it could be through mutual fund, it could be direct investment. A person has to have patience, and there are cycles, economic cycles. They could be a down cycle, it could be an up cycle. So you have to ride the cycles. So riding a full cycle would mean 4-5 years. So whenever a person invests in stocks, the time frame in mind should be nothing less than 5 to 10 years. A business evolves over years. So the idea is that you select a good promoter whom you are comfortable with, whom you can trust your money with, and you feel that they will take care of your interest and grow the business for you and not siphon off money and distribute wealth. For example, some Indian promoters are good, but they are not good distributors. Sure. So you need good distribution also. So you select such promoters. Select industries which are growth areas. You see that this is the area where the pie is increasing fast, say growing 2 times the GDP or 3 times the GDP. Such industries are to be selected. And whoever is the leader in the industry, a leader will always be a leader. A leader is a leader because of qualities. So you go with them and remain invested over a period of time, and that is the way people make money.
Yes.
Unfortunately, I found that as I have seen in the last 25 years that we moved from physical to demat shares and outcry system to a screen-based trading system.
Yes.
And prices being available on phones and everywhere on the tap. So that has converted a lot of investors into traders, which is so automatically the investment objective becomes very short term,
right,
which is actually destroying the investment fabric.
Right.
So investors should not bother too much about the prices, too much about stocks. Just buy a good stock and wait. And in case if you are convinced that your stock is good, the management is good, in case there is a decline in the prices for any reason, you can add more and just wait.
Yeah.
And automatically the eggs will hatch and chickens will come out. That will happen.
Yeah, don't get affected by one quarter, maybe one result going up and down.
You're talking of quarters, I'm talking of years.
Years, I know. 5 to 10 years is a long period of time. Let's just recap that. Okay, folks, one was a promoter that you're comfortable with. Second was a very high growth, or rather, an industry or a company that is growing faster than the GDP, and then just wait. Just wait and let time play its role out. Don't get too emotional. Stick to investing and know that investing is different than trading. Okay, Jay. So now we've got this framework. Okay, which has to do with promoters, which has to do with sectors, which has to do with stocks. Let's talk about the method to choose to implement our decision. One is mutual fund, one is equity. Okay, let's talk about mutual fund. What's your view there?
Mutual funds have evolved well, and in the last 15 years we have seen that the quality of service, quality of management of funds has improved, and generally mutual funds are given decent returns. But mutual funds, the way they are structured, such that there is a cost involved in, and you get returns which are not the best, but reasonably good. So equity mutual funds have given returns. So when you select a mutual fund, you look at the past history. But again, every mutual fund market, okay, last 3 years I did this, or last 5 years I did this.
Yeah.
So we should look at little different time periods also, shorter and medium term time periods also. And on that basis, you can select mutual funds. But if I feel the investor is comfortable in investing directly,
sure.
We always believe that indirect investment is the best. So you can specifically invest in particular companies or industries which you are interested in or you feel are the growth sectors. And that's the way forward we look at.
Fantastic. So what if one of our listeners calls up Toshniwal Equity and says, okay, Jay, I listened to what you said. Now let's get down to the business. Okay. मुझे ये बताइए, tell me specific sectors, specific stocks that you guys like. So what would your answer be then?
Our view is that as we evolve now from today, consumer behavior is changing. The lifestyles are changing. So companies who are in lifestyle businesses, consumer businesses are the companies which will do well. For example, cooking at home is reducing. I think when I meet people, I find that over weekends, practically no one cooks at home. They all go out.
You're right about that. We don't, at least.
And then ordering food from outside. That has also been increasing. So this is a lifestyle change.
Right.
So when we have ladies who are qualified, also working, so they won't have time to do all this routine cooking activity. So I find that people into food business, companies into food business, that's an area which is going to be a big growth area. So large companies who are in this business would see a disproportionate growth. For example, Nestle is big on foods. Livers is big on foods overseas, not too much in India. But I think Hindustan Unilever is a company which is developing on foods. Amongst homegrown brands, I have found Haldiram is one brand which is now evolving well. They have come into with various products, large distribution also. And today there was some news about the company.
They're not
listed as yet,
that's
but someone investing, some foreign company
Kellogg's was supposed to be.
Right. So once it is available for people, so that could be a homegrown brand which is also doing well. So foods is one area which I'm very positive. Then secondly, I find entertainment. Now earlier we used to see what was being shown. Now you see what you want to see, when you want to see, where you want to see. So which means delivery of content and content per se.
Yeah.
So presently we don't have too many content providers. We have Eros International and some companies, Z Online, but still I feel that area has to evolve more. Netflix is not available for us.
Sure.
And in terms of delivery, we have the internet companies, for example, Jio and other telecom, Airtel or Idea telephone companies. So I feel a company which is able to offer you content and delivery of content. And mobile is the king today.
Obviously.
Everything is there into the mobile.
So
people who are able to reach you through the mobile give you what you want.
Right.
So these are the companies again we look at.
Yeah.
Then third would be on financials. Now money is there, and as we say, the economy is growing.
I'm going to just stop you there. So folks, when Jay said that Netflix is not available, he meant as a stock. Okay, you're free to buy Netflix.
Yes.
You can subscribe to Netflix on your mobile, but you can't buy maybe you can buy Netflix stock sitting here in India, but that's subject to RBI regulation, and that's a separate thing. What Jay meant was that content delivery and content creation, two big sectors.
And the third one would be finance, since our pie is increasing and money available with each person is increasing, disposable money is increasing. So companies who are able to offer you good financial products, manage your finances, they are the areas which we can look at, which would include the banking sector and probably some few NBFC companies and some wealth management companies also. So this is another area where I find that we can create a lot of wealth in future.
Okay. Any views within banks and NBFCs? Would you prefer a certain type, public versus private or anything, or you're fairly open to?
I think private sector banks are more accountable, more responsible and more profit oriented. So they are the banks who would look after your shareholder interest. In public sector banks, basically they are owned by government and they follow a government policy, and their objective is to do what the government says. Profits are secondary. So their role is important in the economy as such. But for an investor, private sector banks would give a better return.
Understood. Jay, thank you so much for the entire show, for the content. We are done with that. Our standard ending for all our shows is these two questions. The first is any mistake that you've done financially, of course, in your life, and that what you learned from that, maybe you can share that with our listeners. That's the first question. Definitely, mistakes are the best teachers. I've also gone through the same phase, and earlier we used to always feel that okay, apan to hushar aadmi hai, so we can with always. With the CAIM degree, of course, you are hoshiyar, yaar. But you always feel you can beat others on these things. So we ended up investing in few small cap companies, mid cap companies, based on promoters' rosy outlooks, and many places we lost money. And but the mistake which we made was we were not able to continuously evaluate the company's performance on a quarter-to-quarter basis and benchmark their actual performance against what they've been talking. So if that was done, probably we would have exited much earlier. Sure. So the lesson from there is that try to be with large cap companies, the leaders of the industry. So less homework for us. Sure. Okay. And finally, any book or movie or any interesting content that you could recommend to our listeners that you think would help them make smarter investment or financial decisions? For readers, I have a few books if people want to understand. Please. If there's an author called Arthur Haley. Of course. About 50-year-old. Yeah, is Jaws, I believe? No. Hotel, Airport, Money Changer. So he's Strong Medicine. Strong Medicine, yeah. So he's an author who has written a book on each industry. So your Money Changers for banking, your Evening News for the media, then your Overload for power sector, your Hotel for the hotel industry, Wheels for auto, Strong Medicine for the pharma. Yeah. So when you go through the book, you see the depth of knowledge he has. He understands the whole industry, how it works, the in things of the industry which are brought out. So by reading these novels, you will understand the working of that industry, pulls and pressures internally to the industry. So that would give a lot of insight into how the industry works.
Then you can look at The Intelligent Investor by Grisham.
Yeah.
That's sort of a Bible for finance.
That's Benjamin Graham.
Yeah. And then on movies, I would say there's a movie called Wall Street, which people
classic.
have seen.
Yeah.
And Wolf of Wall Street is little on the extreme side, but that's there.
Upgraded version.
Yeah. So these are books you should read. And another thing I personally feel is that read biographies of successful people.
Very interesting.
So there are lots of books by a lot of people. For example, there's a book on Ghosh, Bandhan Bank.
Yeah.
Then you have books on Lee Iacocca. You have Jack Welch. And various. So read such books.
Okay.
Understand the thinking behind those people as to why they did what they did and what made them click. They also must have made mistakes.
Yes.
So by reading their biographies, they have lived it for 50 years.
Right.
You can read it in a couple of hours probably.
That's fantastic and very, very, very valuable advice. Folks, that was Jay Toshniwal, CEO of Toshniwal Equities, talking about wealth creation in equities. And thank you so much, Jay, for sharing your insights with our listeners.
Thank you. Pleasure to be with you. Thank you.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Hey Amit, what do you think about starting a dating podcast?
To be honest, I think that idea is kind of garbage.
Sure, just like dating then.
Oh, we could call it dating is garbage.
We could talk to people about their sad dating lives.
Okay, I'm not so sure about that.
And we can discuss our terrible sex lives.
Okay, definitely not that.
We could talk about how there's no such thing as love and it's all a load of crap and nothing can ever truly bring meaning to our lives.
Okay, you might need some help there.
Alright, it's a yes then. Dating is garbage. Every week, we break down all things from dating apps, social media, texting, calling, dating rules, and more with some really cool people.
Episodes out every Thursday on the IVM Podcasts app or wherever you get your podcasts.
Hi listeners, we at Aditya Birla Sun Life Mutual Fund have come up with a special podcast series called MF 101 in collaboration with Bloomberg Quint. MF 101 is an informative series that will help you understand the recipe behind mutual fund investments. And what's more, it's coming from the chefs of the mutual fund buffet table, from the very own fund managers and analysts who are the manufacturers of the funds that help you realize your investment goals. New episodes out every Monday. You can listen to the show on the IVM Podcast app or wherever you get your podcasts.